Hello, everyone, and welcome once again to another episode of Under the Macroscope, our weekly podcast. And we welcome back from a fairly short sabbatical, Chief Strategist in the London office of Skybound Capital, Jabir Sadawala. He's had two well-deserved weeks off the podcast, but that means he's come back armed with loads of information. And coming up later, we're going to be talking about some fascinating statistics and arguments around the return to work strategy post-COVID and what it means for landlords, for tenants, and for businesses as a whole. But before we get there, Jabir, one of the big stories, certainly for us out here in South Africa in the last week, has been the continued strength of emerging market currencies. The Rand going to long-term highs against all major currencies. What's going on in EMs?
Yeah, thanks, Matt. Good to be back. And lots happened over the last 3 weeks or so. So I think it's a combination of factors here. We are, first of all, seeing a huge economic pickup. I mean, by any standard, if you look at the data, particularly the activity numbers as reflected by manufacturing and services PMI, we are seeing some really substantial pickups here. Very comfortably in expansion territory. That means people, factories are humming. People are producing things. If they are producing things, they need raw materials. And where do you go for the raw materials? So that will definitely be an impact, especially on commodity producers like South Africa. So that's constantly going on in the background. But I think a more recent phenomenon is around the employment numbers in America. And I would say be very careful with these. There's a view here, as expressed by both the April and May payroll numbers, that things are not going to pick up as quickly as people originally thought, and as a result of that, the dollar has sold off. So it's more a case of the dollar selling off rather than emerging market currencies, including the Rand, going up. Currency. But just a word of caution here. There are contradicting stats. For instance, if you poll small to medium-sized businesses, they are still struggling like mad to find labor, to the point that they're now offering incentives to actually get people out of their holes and come back to work. McDonald's recently has started contemplating giving a pay rise of 10% to over 36,500 of its workers. This is a big step. And there are plenty of other examples of companies that are trying to dangle carrots here.
Talking of dangling carrots,
in America,
I heard of another fast food chain in the last week that was offering an iPhone as a sign-on bonus.
Well, I'm ready to. That's not a bad temptation, frankly. It might do the trick. Who knows? I think the point here is that in America, especially, they are now reviewing these subsidies. This $300 a week subsidy that's being given in something like 25 Republican-controlled states. They want to get rid of it. And those same states account for over 40% of the total workforce. So that's how significant it is. So I would say to people, just be careful. These lower than anticipated numbers do not imply that something's wrong in the economy. There's no slowdown. If you look at the job adverts, if you look at the quits ratio, the rate at which people are quitting their jobs, and so on, it's very, very strong, all of this. There's a thriving job market there. It's just that it's leaving a vacuum. And this is where we've got to be careful. And another statistic that I came across is that in the emerging market world, in order to try and tame inflation, 37 of them have seen a net increase in interest rates by their central banks. There was a net 1 increase versus a net 4 increase in April. Brazil raised its rates 75 basis points, or 0.75%. This is the second in a row because it's seeing a rising inflation issue. Armenia hiked rates to 6%, while Ghana surprised markets with a 1%, a whole 1% rise to take it up to 13.5%. Now, in Africa, you have to remember that as across emerging markets, and I've written and we've talked about this before, there is a theme around food inflation. And one of the ways to try and curb your input inflation is by having a stronger currency, because it just means that your input costs are lowered. That's all it is. It's a currency effect, but it's a very powerful way of doing things. So, any attempt to try and just cool things down on that side of life is going to be welcome. But it has adverse effects because it means that exports become more expensive. So, what does this mean potentially from a portfolio allocation perspective? Well, I think it shows that emerging markets, which have already benefited from reallocation towards it, now a potential investor gets a further boost because you're seeing an increase in the local currency. So that's something to factor in as well.
Just before we get on to our property topic, the commercial property side of things, just a quick word on resources. You've mentioned them already, the way that they have rallied globally, that manufacturing numbers are up. I know you've always been a bit of a South Africa bull, but given this surge in resource consumption, good news for South Africa in your opinion?
I think very much so, and it's even more compelling when you look at, for instance, so let's take the automotive market. Okay, as I think most people know, there's this huge shift to electric vehicles.
Yeah.
Right now, the consumption of raw materials, and particularly metals and specific metals in electric vehicles, is more intense than ever before. And when you look at the list of countries that you can go to get those raw materials, those metal sources, elements, there are very few actually. It's actually a condensed list, and I'm glad to say South Africa's on it. So I saw one headline that said that copper is the new gold, and that's a very telling headline because now the consumption of the demand for things like copper, but by no means limited to copper, is going to become very, very acute.
Yeah, I also read about an increased demand for platinum as well, which augurs well for South Africa. Jabs, let's talk about commercial property. You've had your time off the podcast, but we've been consuming on a weekly basis your very excellent written week in review, which sums up a whole lot of macro issues. And a couple of weeks ago, you highlighted a Reuters poll around sort of return to work policies, how that's impacting landlords, tenants, and how different objectives and different agendas from the various role players are coming into sharp focus right now.
Yeah, exactly. I mean, it was a great article, and I'm pleased I came across this. So it actually started off with residential property markets, and what Reuters did in this poll was to interview something like over 100 property market experts over a period between the 11th to the 24th of May. And the general conclusion, I mean, so we're talking countries like US, UK, Canada, Australia, Dubai. The conclusion was that residential property markets would absolutely soar. And the underlying theme is that, people are moving from urban to less urban. And despite the increasing input costs for building a property, things like lumber, which we've spoken about before, it's not really stopping them. We're seeing staggering, house price increases. But what struck me, and also, by the way, in the UK, typically London has led the way, but this time London is seeing the lowest increase, about just shy of 3.5% year on year. But the outer regions, from north to south, southwest, southeast, etc., we're seeing close on double-digit rises. So there's a very big shift going on here. The article then went on to look at working habits. Now, one thing that I'm quite fascinated by, and it's still early days, is how has life changed after COVID? And one topic that comes up all the time is, oh yes, this has changed our lives in a big way, and especially the lifestyle working, remote versus hybrid. So hybrid being part home, part work. And at first glance, you'd think, yeah, okay, that makes sense. But the article then went on to have a look at this whole business about flexibility. And I don't think it's so straightforward, because you have two different groups here at play. So you have obviously the big commercial real estate owners who have a vested interest in supporting anything that's hybrid, because they want, at the end of the day, people to go in and take up their office space again. And on the other side, you have the employers, employees, and of course the public transport operators who are saying that it's not so easy to actually operate like that, because it's very expensive and inefficient. And as a London transport user, yes, I've seen a pickup lately, but it's not back anywhere near pre-COVID levels. Those horrible experiences of being stuck on a tube, and standing room only. So that's extremely expensive. So I can't help coming to the conclusion that where an employer can break their lease, and actually, and provided there's little or no penalty attached to it, then why would they just suddenly facilitate remote working? Because there's an additional expense in helping that employee to kit out their office at home. Doesn't matter how big or small it is, but there's something that has to be done. So they're paying a fixed cost for their lease, which they can't get out of. Now suddenly they've got employees who potentially are looking for or might wish to work from home. So actually their real lease cost has gone up, because on a per head basis, it's now higher. And then let's just look at this whole business about efficiency, because nobody ever looks at that. It's always very easy and grand to talk about efficiency and how much better you can work from home. But some interesting stats. So if all employees work from an office, naturally you get 100% collaboration, right? That's a no-brainer. If that now reduces to 4 days per week, that collaboration drops to 64%. If you reduce it to 3 days per week, it actually halves further still to 34%. For 2 days, it's 16%. And obviously 1 day a week, it's an abysmal 4%. And one thing that certainly I've come across is people say they miss the interaction. They've been struggling to close deals because they haven't had that chance to have that face-to-face meeting. So then what do you do? And there's a health side, because you're not getting up and moving around and going to the office, getting that walk in. So I just don't think it's going to be that straightforward. And for me, it starts with the employer. If an employer can break out of that clause, fine. Then they'll look at something different. But from what I'm seeing, London prime areas, no landlord's going to give it up. Right. So then this week, I came across another article, and this was very, very fortuitous, on the same thing about hybrid working, but specifically referring to banks. And in this one, NatWest announced that it expects about 13%, 13% of its staff to return to primarily office-based working, while 55% will adopt hybrid working, and 32% a remote first model, i.e. minimum 2 days per month, 2 days per month. So this is for banks. And then HSBC is aiming to cut its office footprint by 40% over the long term. It didn't specify what that timescale is. But HSBC is one of the banks that's in full office cost-cutting mode. It took Deutsche Bank a long time to cut its costs, and it's now become a leader again. I'm starting to see it, on the buy lists of many institutions. So you can see where this is going. So I think COVID has potentially presented these banks, especially, an opportunity to expedite something that had already started before COVID. Now they've just got an excuse to ramp it up a bit. NatWest, incidentally, was very quick to say that they have no immediate plans to close more offices. Well, let's just watch that space. But how much real estate stock is going to come back onto the market? I mean, there are banks everywhere. What's going to happen with these real estate stocks? Are they going to go to commercial world, or are we going to see flats being made out of them? Because there's obviously a big demand for property right now, residential, as to my earlier comments. So it's, developers are going to have a field day, but one should not confuse, and this is a sort of headline thing that will happen, one should not confuse the fact that banks are now looking to restructure by taking advantage of a situation that helps facilitate their cost-cutting program. To me, that's what it does. But it doesn't change anything as far as I'm concerned in commercial world.
Well, it also leads to a fascinating topic for a future podcast, and the rise in digital banking services, and the specialization thereof.
Exactly. Yeah, I completely agree. It's the kind of role that can and should be done, by telephone banking. I always want the comfort of knowing that I can speak to somebody. Well, for that, you don't need an office. The last time I went into a bank, honestly, it was just such a long time ago. It was ridiculous. So no, this is leading to a very different model, but not to be confused with the wider commercial real estate world.
Well, I have to say, I mean, I can't wait to collaborate with you in person again. It's been way too long. And it's also been too long that you've been off the podcast. So it's great to have you back. And we're not going to let you go off on another sabbatical right now, because we've got some great topics for next week as well. But as always, great to catch up with you, get your views. Always fascinating, and to see how they play out in investment strategies and allocations. So thanks for your time and your views. We look forward to the next one. Don't forget that you can access the Under the Macroscope podcast on Apple, Spotify, and on the Google podcast platform for Android. And all our past podcasts are available at Skybound Capital's website at www.skyboundcapital.com. Till next week on Under the Macroscope, have a great week.